Good morning, everyone. My name is Shreya, and I'm with the Ananta Center. A very warm welcome to everyone, and thank you so much for joining us today. Today, we are hosting a very special session under our webinar series on economy and policy. We have the top three CEOs in the country today with us as speakers, who are not only our corporate members, but also very, very special speakers. We have with us today Dr. Naushad Forbes. He is the chairman of the Ananta Aspen Center and the co-chairman of Forbes Marshall. Then we have Mr. Deepak Shetty. He's the deputy CEO and managing director of JCB India Limited. And we have Mr. B. Thiagarajan, managing director, Blue Star Limited. Thank you so much for making the time and joining us today. We're delighted to have you. We also have with us today Mr. A.K. Bhattacharya. He's the editorial director of Business Standard to moderate the session. Thank you so much, sir, for agreeing to moderate the session and guiding this series. Without further ado, I hand over to Mr. Bhattacharya to take over and start the session.
Thank you, Shreya. Very good morning to you all. Special grateful thanks to the panelists for readily agreeing to be part of this session, which is appropriately called Taking Stock of the Indian Economy. It is customary to introduce our speakers, but Shreya has already done that. We have Dr. Naushad Forbes, who is, as she said, co-chairman of Forbes Marshall. He's also the chairman of Ananta Aspen Center, Bharatiya Yuva Shakti Trust, and Center for Technology, Innovation and Economic Research. We have Mr. Thiagarajan, who, as we know, is Mr. Managing Director of Blue Star Limited. He has been around 4 decades of experience, having worked for reputed engineering companies such as Larsen Tubro, Beetle Systems, and Voltas. And we also have Mr. Deepak Shetty, who is at present the Deputy CEO and Managing Director of JCB India Limited, India's leading manufacturer of earth-moving and construction equipment. Earlier, he was the Vice President, Executive Vice President, in charge of sales, marketing, product support, and business development for JCB India and the South Asia region. The discussion that we want to have today will be on the following lines. We will first, after I make my opening remarks to set the context, I will request 3 of our panelists, starting with Dr. Naushad Forbes, Mr. Thiagarajan, and then to Mr. Shetty, to give their opening statements on this issue of how do they see the economy faring, and how do they see the economy doing in the next 6 months or 1 year. So if they can comment on both the state of the economy as they see right now and the way they look at it faring in the coming 6 months or 1 year, it will give us a kind of a perspective. And then we go into a short question answer session, and then that will culminate into in what I think is the most important part of this discussion, which is taking questions from our participants. And I would request our participants not to wait till the session, our preliminary statements are made. They can shoot their questions, send their questions through the chat mode, and our team of excellent secretariat people will actually collate them, and we will make sure that we will try to pick as many of them as possible. Just to give it a brief context, as we all know that the Indian economy, which is measured by the gross domestic product, actually contracted by around 15% in the first half. The full year's expectation is that there will be a contraction of around 7.5%. The earlier expectations were it would be, the contraction level would be in double digits, but now it seems, since the third quarter and the fourth quarter is expected to do better, the full year contraction will be lower at 7.5%. In spite of that, it will be one of the steepest contraction ever that Indian economy has seen in many decades. Actually, since the data was made available, made public, India has never contracted beyond 5.5% in its history. So this will be the steepest contraction. Uh, the good news is next year, which is the growth rate for next year, and general expectation is that the economy would do better. It will bounce back with a growth rate of 12%. This is understandable because after such a deep contraction, this is the economy is likely to recover because of statistical reasons. Not to ignore the other aspects of what is going on in the economy. The inflation is on a high. In a sense, it has stayed above 7% so far. And the expectation is that the current year will see 7% inflation, which is a bit uncomfortable rise because we have not seen this kind of inflation since the inflation targeting regime was put in place in 2016. So this will probably be the first year when we will see that the Reserve Bank of India mandated tolerance band, upper band limit of 6% will be breached. And most probably Reserve Bank of India will have to make a kind of a report to the government of India as per the RBI Act and why it breached that, that upper band, tolerance band of 6% for 3 consecutive quarters, and what it intends to do to bring the inflation back to its desired level. Um, there would be views on it, and I'm sure our eminent experts here would comment on that, whether 7% inflation is good for the economy or it is bad for the consumers. We can't ignore exports. Exports are still to recover. In the first 8 months of the current financial year, exports were down by 19%. But the trade gap was looking better because oil prices are still, although they are rising of late, the still imports are down by 36%. So the trade gap is lower at 32 billion. Foreign exchange reserves, which is a great, area of comfort, are actually rising rapidly. And probably this year we will see an current account will be in surplus. Unemployment is currently ruling at lower than the pre-COVID levels in February. But the worrying part there is that the labor participation rate is less than 40%, is around almost 38%. So with a lower labor participation rate, which means that a lot of people who are earlier in the job market have gone out of the job market. So they're not even looking at jobs. So that's worrying part. The interesting bit in the economy is that the stock market has done very well in the last few months. Actually, if you take this financial year, the stock market so far have boomed by and is increased by 77% from the low of March end. Now, this is a good thing for the stock market, but what does it mean? Does the stock market know something that we don't know? Maybe they see a recovery taking place in a sustainable place in the next 6 months or 1 year, which is why they are so upbeat, robust, optimistic. One piece of information that I want to share before I request my panelists to join is that this recovery has happened riding on greater efficiency of capital. In a sense, the corporate earnings are up. And actually, the second quarter corporate earnings, the top listed firms, actually profits went up by 25%. And this has largely happened because they've been able to suppress their costs Actually, one of the biggest cost element which has gone down is the employees cost, which is the lowest in the last 10 quarters. So what does it mean for long-term demand, sustainability of the recovery? That's a question that I would like to leave with my panelists. And will it make the recovery unsustainable? And um, the government role in this is something that needs to be debated also. That what should the government do? Should it spend more at this time? Should it stop worrying about fiscal deficit? Or should it also look at how it can address the larger public finance issues um, and not get destabilized by the recent developments on some of the reform measures that the government has taken. So that is broadly the situation on the economy front. And we this brief background, if I may describe that, I would now get into inviting our panelists to make their preliminary statements, probably 5 to 7 minutes each. And can I start with Dr. Forbes? Dr. Forbes?
Thank you, Ashok. Thank you, everyone, for being here. This is a discussion I look forward to very much. And Ashok, thank you as always for your, as always, comprehensive and at the same time very specific and precise uh, assessment of where things are just now. I'll spend just a minute actually on where things are and then move more and spend more time on your second question of how do we see things going? Because I think I just want to set up the where things are as context for where at least I see things going in the next 6 months. Where things are, it seems to me, is, as you mentioned, we're seeing a recovery taking place. But I think it's good to recognize that our performance this year has been hugely differential. Some sectors are doing very well, surprisingly well in some cases, expected well in others. Other sectors are doing very poorly, expected badly in some sectors, and surprisingly badly in others. And I think it's good to be clear on which those are. So if you look at where we are now, the -7%, -24% growth experience of the first half of the year, the first 2 quarters, reflects in very different performances. So the pharmaceutical and chemical sector is doing very well, has done well right through. And I would say that's expected. Food and beverage has been doing very well. I would say that's also expected. Two-wheelers has been doing well. That's a surprise. How come? And people are saying, well, it has something to do with stocking, restocking levels. It's not actually end-use sales, etc. When we hear Deepak in a couple of minutes on JCB, I understand, is having record sales in recent months, in the last 2-3 months. That to me is surprising. And where is that? Yes, I'm told the demand's coming from rural, but how come? And what does it mean in the longer run? Let's take the sectors that are doing very badly: travel and tourism, construction and real estate, and if you take retail. All of them are running at roughly, at the end of 8 months, are running at roughly half or less of last year's average. So really in deep trouble. Travel and tourism, expected, given the pandemic, given the uncertainty on the health front, you'd expect it to be doing really badly. And the recovery that's taking place is taking place, but it's very marginal. And will probably not be robust until the health issue is behind us. Construction and real estate, I would have hoped to have seen a recovery by now. Why haven't we? That's to me a surprise. in terms of, I'd say, doing surprisingly badly. Retail, initial fall, I can understand, but why do we continue to see such depressed demand in retail? I think surprising to me also. So that's sort of my picture of where we are now. It's this mixed picture of sectors that are doing very well, as you'd expect, and some surprising, and a picture of sectors doing very badly, as you'd expect, and some surprising. So where does that take us now? And I think I'd like to start with your numbers, Ashok, which to me are very striking, and two sets of numbers. The first set of numbers is that on the backdrop of minus 7.5% Q2 growth, we have plus 25% growth in corporate profits. Yeah, the point that you made up, and that's what's driving the stock market and so on. That's a very striking divergence between the macro picture and the micro company performance picture. Second, on the trade front, with depressed exports, even more depressed imports, an improving trade deficit, showing in foreign exchange reserves, showing in a strengthening rupee, I worry. I think those are, to me, all negative indicators. So I would see an improving trade deficit coming from a fall in imports that's greater than our fall in exports. I would see this as a negative. It's a reflection of depressed domestic demand, and it's a reflection, if you ask me, especially of depressed domestic investment demand. Because a lot of the machinery imports, etc., is where we've seen the biggest falls in import numbers once you leave out the oil price fall. Take the second factor, this divergence of stock market and corporate profits and GDP growth at the overall level. That's very troubling to me because it says to me that, because when you, as you know, you can calculate GDP in three different ways. One of the ways in which you can calculate GDP is overall income, and you'd say, okay, look, GDP growth minus 7.5% comes from plus 25% corporate profit growth, right? What on the indirect taxation side? Probably, I think it's also somewhat negative in Q2. Not hugely, but somewhat negative. Small enterprise profits, right? Which must be strongly negative if you think of it. And wages. That's the equation. All of that, so plus 25%, and then these three other things of indirect taxes, wages, and small enterprise profits has to add up to a huge minus to make up for the plus 25% and still get to minus 7.5% GDP growth overall. That says exactly as you say, Ashok, that we're seeing returns to capital rise, and we're seeing the share of GDP going to capital rise. We're seeing the share of GDP going to labor fall. That's very troubling for the Indian economy. We should remember that over the last 30 years, 60% of our GDP growth has come from consumption. And if 60% of GDP growth comes from consumption, where is that consumption growth going to come from in the longer run, medium run, even short term, next 6 months, right? If wages are so depressed, if small enterprise profits are so depressed, that's, corporate profits is not going to make up for it. Yeah. So, and at some point in time, things are going to catch up with corporate profits as well. If we do not see a recovery on the wage side, if we do not see a recovery on the small enterprise profit side, and if we do not then start seeing that whole cycle start turning around to something that's much more virtuous, where more and more labor earns more and more, and that drives consumption, which then drives investment, which then drives corporate profits. I would much rather see it happen that way instead of corporate profits being driven by cost cutting. So I think, so my outlook for the next 6 months is that maybe we'll see some continuation of this profit growth. I hope, in fact, that we will not. Because if we see continued profit growth at the expense of labor, I think actually, we're digging a deeper and deeper hole from which we will have to get out of in the longer run. I'll stop at that point, but I hope we can come back to a
Sure,
discussion around
sure,
this going forward.
sure. Absolutely, absolutely, absolutely. Thank you, Dr. Forbes, for this explanation of the nature of the economic recovery going forward. And I'm sure we'll come back to it. But let me now turn to Mr. Tyagarajan and understand his perspective. Does he also feel similarly, or as somebody who is heading a company in the manufacturing sector, does he feel differently? Mr. Tyagarajan.
Thank you, Mr. Bhattacharya. To begin with, it's a privilege to be part of this panel. I will truly enjoy this session. The first thing is that I am a firm believer that there is a huge revival takes place after crisis, and I'm optimistic that we will make use of this period to put the Indian economy on a different orbit. At the same time, I'm fully in agreement with Dr. Forbes. I'm particularly concerned about the employment generation and also certain other parameters, that what part of our GDP gets invested in terms of healthcare or in terms of infrastructure creation or the R&D. So these are some areas I am concerned about. And coming to the sector that I'm closely associated with, two important sectors. One is the consumer durables, the other is the commercial real estate. So it's a golden period for the consumer durables. Actually, the festival season that I witnessed, that demand was not there. I do not recollect, even during the past 6 years, it was not. And it was in 2014 we had witnessed that kind of a demand growth. While the Q1, it was at around minus 65%, that it was at 35% demand for air conditioners. That has come to around 100% demand at this point of time. And at the same time, it was a wake-up call for the industry, and aided by certain policy initiatives by the government. Like that, you're aware, air conditioners was specifically identified as one of the sunrise sectors, along with leather, along with shoes, and along with the furniture. So the first question is whether the demand will be sustained. It continues to be sustained. And number two, there are very clear visible indicators, much pronounced, that 45% of the purchase happening through credit cards or the interest-free finance schemes. Next one is 65% of the sales coming from tier 3, 4, 5 towns. The metros are insignificant now. Now, on the other hand, in terms of policy, that putting non-tariff barriers, that import should be curbed, and aided by another program of a production-linked incentive. And we have to see how this transition will be managed intelligently. Like for example, you need to compete with China, which has a market size of 110 million. And we are at India's market size is around 6.5 million with a 6% penetration. Now, you don't have scale, your cost of capital is very high, your input costs are high, the raw material costs in India due to several controls that prevail. And the one and the only way you will be able to compete and participate in the global trade as far as the consumer durables are concerned is through R&D and innovation. So with the cost of capital high, you don't have scale, you have high input costs. If you want to succeed, it will be the R&D and innovation. At the same time, the question of sustainability or our carbon footprint related initiatives. So you need to work heavily in order to reduce the global warming or the ozone depletion or the carbon footprint on the whole. we have been the industry has been assemblers, that we were getting major components from China, we were putting it together. So there is a big change that is taking place. You have to backward integrate and really get into manufacturing. And we were sort of, I would call it gypsy culture, that we will go to Dadra, Silvassa, then Baddi, then Northeast, and really looking at that a 10-year tax break or a 5-year some concessions. And now it is a moment for us to invest into large manufacturing facilities with reasonable backward integration. So the phased manufacturing program combined with the production linked incentive to the tune of around 5,000 crores that is being offered, which is impressive, which is we all have committed huge investments. So I think we will take off. It is a defining moment for this industry. But at the same time, I think there are going to be consequences that as we have seen in this kind of schemes, there will be excess capacity that will be created. And there will be there will be price drop while the penetration may grow. How the competitiveness will have to be matched. So the question is, it is a golden period for the industry, but it comes with certain pains or certain issues to be tackled, and I suppose we will raise to the occasion. On the commercial real estate, I can again talk from the air conditioning point of view, that each corporate sector employment creates 60 square feet of air conditioned space. So 1 lakh employment in corporate sector, 60 lakh square feet will be created. So the office itself is a question, whether in the new era, how office space consumption is going to be. So is a hotel and the retail, all these things are stressed. And the real estate sector itself was a stressed sector. It wasn't like, even if you take a light commercial, like a shop, showroom, boutiques, restaurants. The silver lining is the manufacturing is contributing, the healthcare is contributing, pharma is contributing. So this part of it is good. And similarly, in the refrigeration related to vaccination or healthcare, these are the sectors which are pushing up the performance. Now, I am sure this industry, at least the manufacturing part of it, will get into hiring. While the cost cutting took place by curtailing recruitment or cutting jobs, I think the recruitment is beginning to take place. And there is going to be also, I can foresee, shortage of talent coming couple of years. And the other related sector, which I am familiar with, is the agriculture, food processing, horticulture. And I know there are some hiccups there to get started, like the farmer producer organization. Related reforms are good ones. We have to see how these alignments will take place politically, and therefore we can look forward to some revival in that sector. Again, food processing has got a production incentive, and it offers very huge opportunities. To add to one of the many concerns which Dr. Forbes mentioned, the last time when we grew, the states were doing well and they were contributing. My worry is that the GDP conditions of states are in very bad shape. And the GST related issues itself. Now, there is another concern that I've got is that are we attempting far too many things that to Atmanirbhar Bharat, and we will become an export hub, whether we are better off identifying a few sectors and putting our might behind it, like the Indian IT sector shined. In that context, the brand India, that how we should build, which markets we should look at. Lastly, I am a firm believer, I don't think we will grow by shutting the door for others. The immediate problem that we have got is, even for the manufacturing investment, which Dr. Forbes touched upon, the machinery for, many machinery were coming from Japan, Korea, and China. And even that is getting into a problem. And I think we have to keep our doors open. The history teaches us, who had liberalized, they have grown. Our own experience is so. So if we have export ambitions, I think we should open our doors more liberally. Thank you.
Thank you very much, Mr. Tyagarajan, for ending your note on a very rather optimistic note that we should not close our doors if we want to grow. Um, may I now turn to Mr. Shetty and give his opening comments on how he sees the economy doing and how does he see it going in the coming few months. Mr. Shetty.
Thank you, Mr. Bhattacharya. First of all, I would like to thank Ananta Center for having me as a part of this discourse with such a learned panel. Both you and Dr. Forbes very eruditely have given the data about the macroeconomics. So I will not repeat that data. I will focus more on the infrastructure sector and more particularly the construction equipment sector, which I represent, which also very much represents the progress on the infrastructure side. So construction equipment undoubtedly integral to our Honorable Prime Minister's vision of building a self-reliant and Atmanirbhar Bharat. With local manufacturing and exports to various countries, I would hazard to say that the construction equipment sector in India, industry in India, is really an embodiment of the ambitious Make in India project. The machines today which are manufactured by this industry are on par with the best of the technologies around the world. And if I can specifically speak about JCB, we very proudly export to more than 110 countries around the world. Including last year, we have shipped our first machines to North America and also to Japan. So, this sector, I would say, particularly very strongly represents of what India can do, particularly on the technology side. Moving on to the specific issue on hand, in spite of the lockdown and temporary halt in construction activity during the pandemic, we are certainly seeing good green shoots of recovery. And we started seeing this recovery right in the month of May onwards. In our industry, we very closely connect with our machines even after selling them to our customers. Like in JCB, we have got 160,000 machines which we connect with on the IoT telematics-based platform. And in spite of the lockdowns in the urban centers, we could see a very brisk activity going on the rural side, particularly in the agriculture sector. And this sort of gave us the confidence that things are going to turn. As you know, the economy and infrastructure are very much linked. And obviously the focus on road projects, ports, etc. will improve the liquidity in the system. But more importantly, this will generate employment. And infrastructure is such a significant enabler to the economy on the whole. If I specifically speak about the road construction activity today, it is between 30 to 32 kilometers per day, as against the single digits that we saw during lockdown. So on the revival on the road construction activity has been actually much faster than what was initially envisaged or any of us would have thought. The number of high-profile road projects are presently in the offing. Particularly, all of us know about this road project between Gurgaon or Delhi to Vadodara, the whole Delhi, Vadodara, Mumbai corridor. It's getting a lot of traction. And similarly, there are other road projects which are launched or restarted across the country. But one of the big supports that this sector has got is from the two projects. One is the Pradhan Mantri Gram Sadak Yojana. And we are seeing a lot of investments taking place as a part of this project. The Manrega related projects also are generating a lot of activity in the rural areas, particularly in the states where the rural ponds, and there's a lot of focus on the irrigation side also. So that is what has sort of benefited, and as Dr. Forbes alluded to, we are certainly seeing a good improvement. And in a couple of months, the improvements have been better, not only compared to 2019, but till the time our memory goes, these were some of the best months. So very positive on that front. Moving on to the challenges, one of the biggest challenges, while we went to a complete lockdown type of situation, the increased demand and that sudden spurt in demand has created a lot of challenge, particularly from the supply chain point of view. We had to work very closely with our suppliers, and many of them belong to the MSME sector, and many of them have lost their critical talent because of this whole migration back to the villages. So we had to work very closely with them. And this is something which I'm sure all my colleagues in the industry also have faced. The second big challenge we have seen is on the liquidity side. And this is something which I'm going to cover in a little more detail. We have seen a complete risk aversion from the banks and NBFCs, and particularly during this challenging time when everybody is struggling from the cash point of view. The dedicated infrastructure funding body, we have been talking about it for a long time, I think is absolutely essential. Last but not least, something which Mr. Tyagarajan touched upon, I think need to be competitive. And here, the input costs are certainly going through the roof. We are seeing challenge on two sides. One is particularly the steel prices, which have suddenly increased in last few months. I know some of this is also tied up to the long-term sort of contracts they have signed up. And it's very sad that today, that when there is a huge demand in our country, the steel is being exported out of our country to China. So all of us who depend on the local supply of steel are challenged both from the price point of view, the cost point of view, and also from the availability point of view. The second challenge, we all work with the global supply chain, and the challenge is on the availability of containers and also on the price of the containers. I think particularly in China, even if you are ready to pay, not in percentage increases, but times increases, still you're not assured of the availability of the containers. And this has certainly become a big challenge. And last but not the least, we always remind ourselves that we are still in the midst of the pandemic. So any second wave, third wave can really hit us. And any local lockdowns can impact us because, again, we depend on infrastructure, on supply chain, which is spread right across the country. So these are some of the challenges that we have seen. Coming to liquidity, the large infra projects need funding, with a 15 to 20 years time period. And this is where we have seen challenges. In all fairness to the banks, they have seen NPAs, which have made them risk averse. And that is adding to the whole bureaucracy in this process of lending. The last mile customer needs funding. We are seeing this whole new group of people, the rural entrepreneurs who are coming forward, particularly to buy our machines. And I want to share some data. Before the pandemic, around 55% of our machines would normally be sold in the rural area. Today, that has increased to almost 75%. So the rural India, the Bharat, is thinking about turning into entrepreneurs because they have gone through the pain of coming back from the cities, etc. But I feel that our whole NBSC setup or the banking setup is still not, it is still very risk averse. On top of it, there are a lot of physical interactions which are mandated as a part of that process, which again creates challenges during the COVID time. I think this whole sector needs to really review in today's digital times how they can move from the physical to digital, maybe not completely digital, maybe something like phygital means of connecting with potential customers, understanding their credit worthiness, and ensuring that they support this whole streak of entrepreneurs which is coming up in the rural area. Couple of learnings from the crisis, I would say the businesses need to be agile because things can change really very fast. Last few days, it is not only the pandemic, but all what is going on the borders of the national capital is also completely throwing our supply chain into a different state. None of us ever imagined a zero revenue situation. So cash continues to be the king. And looking at all the challenges that we are facing, particularly from the logistics side, I think building a local supply chain has become even more important. I think if as a country we need to grow, we need to really invest and focus on developing our local supply chains. If I quickly move on the opportunity side, the NHAI is set to expand. There's a lot of focus now, including on the logistics park. I'm sure this will create more opportunities on the infrastructure side. The DFI for infrastructure funding is absolutely essential. And this is something which we know that the government is working on, but I think we need to bring this to fruition and implement this quickly. The capex from the government has been almost flat for last 6-7 months, and it is time to step up on the spending, notwithstanding the investment on some of the road projects. One big challenge we face, particularly while interacting on the government projects, is this whole focus on L1 and H1. and where the value part is sometimes missed out. And particularly, this creates not a level playing field when some of our competitors who have access to very easy funding from their home countries. And Mr. Tyagarajan alluded to this. And I think for the Indian companies to be competitive in this market, I think we need to go beyond the L1, H1 and start looking at the V1, and also how that V1 adds value to the local supplier base, also along with the local companies. Economic revival can't be sustained only on the consumption. So large-scale infrastructure projects must be rolled out for a strong revival. I'm alluding to, there's a lot of talk about 100 new airports coming, but I think it's very important that some of these large projects also are taken forward. While there is a lot of activity which is taking place on the rural side, the urban side has been a bit quiet. I think there's a great opportunity for us to revive the urban services. The municipalities need to be revitalized, which will again help in improving the economic, increasing the traction in this particular sector. Infra has 6 key elements: roads and highways, irrigation, power, rail. I'm sure will help in this particular direction.
Yeah. And thank you, Dr. Mr. Shetty, for this elaborate explanation of your perspective on how the economy is going to shape up. What I can make out is that from both Mr. Tyagarajan and Mr. Shetty are pretty upbeat on the situation going forward, but Dr. Forbes has got some questions where he doubts the nature of the recovery. But let me come back to you, Mr. Shetty, with a kind of a supplementary question. While you are seeing recovery, you are seeing infrastructure sector, seeing the kind of activity that you haven't seen for quite some time. What is your assessment of the kind of labor participation that you are seeing? Are you seeing labor participating, and at what kind of compensation level do you see the labor participation is taking place? That is one. And number two, do you see any problem with regard to the payment mechanisms for your vendors? In a sense that, you keep hearing about how the vendors are not getting paid, whether it is by the government or by the intermediary. So there are two segments of the economy, which is not the listed entities or the big companies, but the labor, the working class, and the MSMEs, which are the vendors. Now, if they are in trouble, then demand revival and therefore growth revival on a sustainable basis will be a question mark. So my question to you is, do you see labor market is buoyant? Are wages not a problem? And do you see the MSME sector, the vendors, are getting their payments released in good time? And is there a problem there? Mr. Shetty.
Yeah. So first of all, to answer the question of whether the funds are flowing out from the government, I've been personally interacting with some of the major account customers who participate in these large projects. Most of them have confirmed during the interaction have confirmed that their payment cycles are pretty quick. I think a lot of funds have been disbursed by the government, particularly in the last 2-3 months. So the major companies who are participating in this sector are getting their funds. I have not heard of any delinquencies on the passage of that fund further down, including we supply a lot of machines to these companies, and it has been maybe 1 or 2 cases here and there, but otherwise overall it has been pretty robust. I think people are standing up to their promise of making the payments. If I speak about the suppliers, I think today it is actually a labor market, particularly on the manufacturing side. all our suppliers today are not 100% at the level that they would want to. Now, this part is, this particular challenge is created both by the availability of labor and also by the spurt in demand. So I would say that compared to what we have seen 3-4 months back, the whole labor scenario has changed. On top of this, with the restarting of a lot of construction projects, I was speaking to one of our major account customers. It was very interesting to hear that even during the pandemic, they continue to support people who are working at their construction site, and some of their sites had more than 10,000 people. They continue to support them. So companies have really gone out of the way to support the labor, ensuring that when the things come back, they are ready to take it forward. So I would say it is positive. On the rural side, particularly the whole rural infra, the way it is being developed, the road projects, etc. Even today, the level of mechanization is less. So this again creates a lot of opportunity on the labor side. So if I can sum up, I would say really positive. At the same time, there are some stories here and there about some of the payments getting delayed, etc. But overall, I can give you confidence that things are on the positive side.
Okay, thank you, Shetty, for this clarification that I had in mind. Let me turn to Mr. Tyagarajan and modify that question a bit. Because the macro data and the micro data seem to be not gelling here very well, in a sense that the macro data tells you that the listed entities in this country have seen a remarkable depression in their wages cost, which is they have not seen in the last 10 quarters. Now, on the other hand, the perception is that probably the organized sector wages have held up. So what is your sense of the labor market situation in terms of, from a micro perspective? Because the macro numbers we broadly know, we know the CMI survey, we know the labor participation rate. We also see the macro number coming from the corporate data that how their wages have been depressed. So what is your sense is happening in the labor market? The second point I would like you to address is you referred to the production-linked incentive scheme as coming as a kind of a tool by which manufacturing sector will get a leg up. Now, are there any dangers in the production-linked incentive schemes? Will they be a kind of an instrument for introducing some sort of tariff barriers? So, I mean, would you like to respond to these two areas of concern?
Thank you, Mr. Bhattacharya. The first part is connected with the employment numbers and the wages itself. I think it is not sustainable. There was a shock, there was a compression in the business volume and the demand. Therefore, the corporates ended up cutting the wages or cutting the jobs in varied degrees. It is not sustainable. So the question is that cost cutting is not total cost management, which is what Deepak was alluding to. The question is that what are the value drivers and what is the cost laddering, and therefore how I need to do the total cost management given the fact that we are growing and we want to participate in the global trade itself. So the question is that you need right kind of talent and you need to pay them, otherwise you will pay the price for it. So if you want to compete, it's a multinational environment in my industry, consumer durables. I need to attract and retain the talent. I should be paying them accordingly. Same way, if you look at the vendors who are predominantly MSMEs, I need to ensure that they are the best. They will produce the high quality products at a reasonable cost at which it is supposed to be supplied to me. And here again, the job losses as well as the wage cuts will have to be undone. So in quite a few cases, it has been done in a more severe manner, and I think it will get corrected. I also want to touch upon one point which Deepak touched upon, the payment. As a whole, I am not talking about my industry, that I think in India, the effort that is being put in, the time spent by everyone across chasing the payment, which does not prevail in many parts of the world actually. It is an unproductive work. Even with the government, to get your own dues, how much of managerial time is going into this? If you are talking about a GDP, you are supposed to be improving the productivity of the people. And I can tell you, in my company, close to 60% of the effort is on chasing and getting the payments. And this is something that the India should learn, that in the contract conditions, that whether we go ahead and copy FIDIC or whatever it is, we need to reform that. I'll move on to your second part of the question. The PLI scheme, see, any scheme which is throwing money, you need to ensure that it is sustained. Say, for example, that Himachal Pradesh, that there will be a income tax benefit and there will be a excise duty benefit for 10 years. The 11th year, many companies have wound up and moved out of that location. And nothing has happened there. Those places look like ghost towns. And what is the significant development that has taken place there? And therefore, this particular one, you should also be looking at the consequences. I am happy that the government is looking at it, looking at the numbers. So the 3,000 crores in the finished goods investment will be incentive, 3,000 crores in finished goods. In order to earn that, the companies may have to invest close to 6,000 crores. Okay. And 6,000 crores means something like 30 million more capacity will get created. It will not be consumed in the country. It will create jobs, there is no problem, but eventually that companies have to survive means they have to sell those products. In order to sell those products, you have to find export markets. So this is flagged as one of the issues, that unless and until you will be, or the multinationals have to figure out their own export hub will be India or partly India apart from China or apart from Korea and Japan. So these have to be worked out, and we are looking at it. What kind of impediments will come, or we will end up paying a high price at a later date. We do not want this investment to go without delivering the results. That's where we are.
Okay, thank you very much. Before I take up some of the questions that we have received quite a few questions. I will come to Dr. Forbes. We have heard Mr. Shetty, Mr. Tyagarajan. If I were to ask you, and it's a difficult question, I know, and it will be difficult for you to answer in a short time, but if you were to advise the government of India at this point in time, which you do even otherwise, but what should the three things that the government should do to make sure that the recovery that we are witnessing now becomes sustainable in view of the various inputs that we got just now from the micro as well as the macro level? Three quick things that the government must focus on, since we are going to see the budget in the next 1.5 months.
So thanks, Ashok. Three quick things I would say would be, the first is pay one's bills.
Absolutely.
And particularly pay the states their dues. Because actually the point that was made, I think earlier on by Thiag, that look, that state finances are in a mess. They're in a mess largely because they've seen a collapse in tax revenue in recent months. They've had to spend much more on the health side, and they are really struggling with their finances. So pay bills, including to the states. And I think the government has worked hard to pay MSMEs and clear MSME dues. They have not worked equally hard to pay the wider corporate sector's dues. They have not worked to pay tax refunds that are currently pending for larger taxpayers, and they've not worked to pay states their dues up to date. So I think that's the first one. Second is invest in infrastructure projects which will help us in the medium to long run. It won't help us in the short run, but it will help us in the medium to long run. And we really need to see those projects get moving on the ground, whether it's the highway projects that Deepak was talking about, or whether it's wider infrastructure projects, which may very often be done by states themselves. And that will again be then driven by the center paying states their dues so that the states can spend on those local infrastructure projects. That would be the second one. The third would be on trade policy. If you take the entire Atmanirbhar Bharat scheme and the PLI schemes, the production linked incentive scheme, I hope they have the effect that Thiag mentioned of deepening supply chains. But the whole point of deepening a supply chain is to be competitive, more competitive in the medium term. Maybe not in the short term. Maybe in the short term, as one makes those supply chain deepening investments, one will be less competitive. One even needs some protection, etc. One needs the subsidy from the government. But in the medium term, one has to be able to compete without protection. Yeah? So let me give you, so what I would say is that one needs to have that focus in the government on exports and on driving exports. So can the production linked incentive schemes that have been provided be connected directly to export commitments? In other words, can the production linked incentive be provided to companies on the basis of meeting an export commitment that has to rise year on year on year as the subsidy rises too? And if the export commitment is not met, the production linked incentive will not be paid. If we actually connect those two and say that, listen, unless you export, right, you will not get the subsidy. I think it could be quite a powerful way of deepening supply chains in a way that will enhance competitiveness overall. In the same way, let's see some reversal in our tariff policy of the last 3 years. Over the last, actually 4 years now, December 2016 onward was the first round of tariff increases. And since then, we have seen a dozen rounds of tariff increases. And tariffs have only moved up in these last 4 years after moving down for the previous 25 years, right? So, we need to see that start to turn around. So take the example that Deepak mentioned of steel prices, right? Why are steel prices higher in India than overseas? If we can export steel to China, that says we can compete. If we can compete in steel, why does our steel industry need protection? Why are there tariffs of 10% and 12.5% on steel in the country? Because that then ends up actually multiplying efficiency across the entire engineering sector. So I think we actually have a case for reducing tariffs in all primary products, in all intermediate products, even if we keep some on finished goods for a period of time until we can deepen our supply chains and become competitive. So I'd say these are the three things that I would say we should do to make the broader recovery more resilient and effective. Pay one's bills, invest in infrastructure above everything else. Don't give any other giveaways. Don't reduce GST. Don't do any of those things, right? Invest in infrastructure. And third, right, reform our trade policy such that we incentivize exports by reducing input tariffs, connecting the ANPLI scheme entirely with export commitments.
I think that's a wonderful thing, and particularly at a time, Dr. Forbes, when the rupee is appreciating,
very much,
when this itself is acting as a disincentive for imports. So I think we have just a few minutes time left for taking a couple of questions. Maybe there's one question that has come which says that do you think that without comprehensive administrative reforms, any good progress can happen or will happen? For example, ease of doing business, ease of running a business itself is a big handicap due to a negative and rent-seeking bureaucracy. Now, this is a question that Mr. Tyagarajan or Mr. Shetty would like to take and quickly respond before we wind up the discussion.
Thank you, Mr. Bhattacharya. Yeah, this EUDB and all comes much later. My view is that there has to be greater alignment. So the policy reforms, whether there is alignment across the stakeholders. You look at this foreigner dispute itself. So it implies that the pre-work has not happened enough. Fine, it may require more work, but we should pay attention to that. So often you come across the laws or the legislations, regulations imposed, whether there is a greater alignment that it is created. It is better to spend more time than later on. This is one of the things that we should look at, going by what has been happening for quite some time. Here it is taking time, and you end up wasting a lot of time after a legislation is done or after a regulation is done. You take even the company law. Afterwards, we have broken our head to get it and reform like that. So as far as the ease of doing business is concerned, that the institutions such as CII has been working hard across the states to flag it and get it done, but the response has been good. There is no complaint there. That it can happen faster is a different matter. But if we table it with a correct solution or benchmarked with it, this is what is happening in this industry or in this country, this is how we will do. And one other thing that is much more important in these reforms is the rural-urban connect. So, and consequently, the inequality that is prevailing. Dr. Forbes had worked on it as the president of CII, what more can be done towards this. So this is, with the economic growth, this is not going away. The rural-urban divide, as well as the inequality, that is getting only more pronounced. These are more important than the other issues. That's what I feel.
Okay, thank you. Mr. Shetty, if you can quickly respond to this question on what specifically needed to be done to attract investments from foreign countries like Vietnam, Indonesia, and Thailand. Is there any specific agenda that we need to look at before we end it and the discussion? Quick, short.
Yeah, I think the whole thing is about ease of doing business. We speak about making it easy, but it is still not easy. Even people like us who are in this in India for more than 41 years, setting up a new facility sometimes is challenging. It has improved a lot, but I'm sure a lot can be done, because that itself acts like a barrier for people to think about India as an investment base. So something to really look at.
Okay, thank you. Dr. Forbes, I'll just, this is a question I cannot ignore with you on the panel. This question is, says, is the government of India decision not to participate in RCEP helpful to Indian economic growth in the short and the long term? Your comment.
So
I know your views, but I think you need to state it to the audience.
I'll try and give a 3-sentence response. So sentence number 1. My position is very clear. I feel it was a mistake for India not to drop out of the RCEP process, because RCEP brings together 15 other countries that are a third of world GDP, most of world growth, and the future lies in Asia and in trading with Asia. So that's the first sentence, right? That it was a mistake not to be part of the RCEP process. The second point is that our negotiators had worked very hard over many, many years to get us a very good deal in RCEP. The interests of Indian industry were very significantly protected, and we had an adjustment period of indeed 5, 10, 15, and 20 years in some cases. So, we had a very good deal worked out for us in RCEP. And third, right, we should see trade agreements as a way of providing access for Indian industry's offensive interests. And Indian industry can have offensive interests in trading with the world only if it is confident of being competitive. So I think we should see competitiveness at the heart of all of our trade discussion and our trade ambitions going forward. And if Indian industry can be more confident about our own ability to compete with the world, we will then become a force that pushes for our government to sign trade agreements and give us greater access to markets around the world.
Okay, thank you. Thank you, Dr. Forbes. And I think we have come to the end of this discussion. There's one more question which I can, respond in one sentence. So there's a question on, can we use the ballooning foreign exchange reserves, investing it in infrastructure? And the answer is very obvious. We cannot, because technically it is not possible. You cannot use the RBI reserves because for a variety of reasons, it is just simply not possible. So I think, we have exceeded our time by almost 5 minutes, so we'll close it here. But before I close it, I'll just say that we began this discussion after the preliminary observations were completed. I mean, I got the sense that probably there is a divide among the panelists here, that two of us were a little not pessimistic, but we are raising doubts about the kind of recovery that we'll see, and two of us were talking about that how recovery has been robust, and there are every chance that this recovery will be sustained. And I got this impression that probably there is a divide between the micro perspective and the macro perspective. But as the discussion proceeded, I'm happy to report that the divergence has disappeared almost, and you can get an overall sense that yes, there is a recovery, and the recovery is solid. But everybody, all the panelists agree that you need to take supplementary measures to make sure that the gains of the recovery are evenly distributed, and the recovery itself becomes sustainable. So I think with these words, I will hand it back to Shreya and close the session. Shreya?
Thank you, everybody, for joining us. Please stay tuned and do join us for our future sessions as well. Thank you. Thank you to all the panelists. Thank you, Mr. Bhattacharya, Dr. Forbes, Mr. Shetty, and Mr. Tyagarajan. Thank you very much.
Thank you.
Thank you.
Thank you.
Thank you all. Thank you.
Stay safe.
Thanks, Deepak. Thank you, Ashok.
Thank you.